Hello guys, welcome back to my channel. In this video today we are going to be learning a very effective strategy that has worked for me and I believe it will work for you. So pay attention, watch this video till the end, and if you have not subscribed, consider subscribing. Okay, let's jump right into it. So what we are looking at here is a strategy that I've called bias continuation strategy. Okay, I've called it a bias continuation strategy. Okay, in other words, this strategy, okay, is mainly focused on the bias, all right, of the daily candle. Okay, its continuation, whether it's going to continue bullish or bearish. All right, so we are concentrating on a daily candle. We are watching closely how a daily candle closes, all right, and then we can go on from there to determine our next move in the market or our next step in the market, whether we are going to buy or sell. So we are looking at a bias continuation strategy using a daily candle. So we are going to be focusing on a daily candle, and also later on I'll show you how you can place your entries at lower time frames. All right, so stick with me till the end of this video and consider liking the video and also subscribing to this channel if you haven't already. So we are going to be looking at bullish continuation, okay, and also a bearish continuation. All right, so we are going to be looking at those two. All right, bullish and bearish continuation. So first of all, before we go any further, I'm going to define the different parts or show you the different parts of a bullish and bearish candle. So this is a bullish candle. For those who don't know, this is a bullish candle. Okay, it's called a bullish candle. All right, I'll color code that blue because most traders, or green, let me color code it green, because most traders on their charts like to color code this bullish candle green or blue. So I'll use green and blue to demonstrate here the bullish candle. So this is a bullish candle. All right, this is a bullish candle. Okay, from its lower tip to its upper tip, and I'm going to define all those parts. All right, so this is a bullish candle. For those who are completely new in the forex market, this is a bullish candle and this is its different parts. So from the beginning of the candle opens right here. This is the open of the candle. Okay, that would be the open of the candle. All right, that would be the open of the candle right here where the arrow is pointing. This would be the open of the candle. It opens here, and then this candle closes up here. Okay, this is the close of the candle. This would be the close. It closes here. All right, and then this would be the lowest price of the candle of the day. This would be the lowest price. The lowest price. Okay, this is the lowest price. Okay, as indicated by that lower wick. This is the lower wick. Okay, so this would be the low of the candle. Let me just call it the low of the candle. This would be the low. Okay, this would be the daily low of the candle. Okay, let's just use daily low. All right, okay, so that would be the day low of the candle for that day. Day low. Okay, this would be the day low. That means the lowest price of the day would be here for this bullish candle, and then the day high would be up here. Okay, we would call that a day high. So that would be the highest price of that day, okay, within this whole candle. And in between here, we are looking at a wick, okay, from this open to this close, this is the body. Okay, stay with me here. This is the body of the candle. Okay, from here, from the open to the close, that would be the body of the candle. Okay, that would be the body. This one here is the body. This one, this whole area is the body from the open to the close up there. That is the body of the candle. All right, so that would be the body. I'll just indicate it there. This is the body. Okay, this is the body of the candle. All right, and this is the lower tip or the lower wick. This is a wick. It's called a wick. This protrusion you see down here. Okay, this protrusion is called a wick. Okay, I'll just mark it out there. This is the wick, this one. This is a lower wick. Lower wick, some people call it a shadow, but I like to call it a wick. This is a lower wick, all right? And this is the upper wick up here. This is the upper wick. The upper wick or shadow, whatever you want to call it, okay? So these are the different parts of this candlestick, all right? It's a bullish candle. It represents buying pressure. Pay attention to that. This candle represents buying pressure from the bottom to the top. It represents that buyers are in control. Whenever you see this candle on your chart, it represents buying pressure. All right? This represents buying pressure. Okay? Represents buying pressure. So whenever we see this candle, we are anticipating buys. Okay? So this is buying pressure. It means buyers are more in control within this candle movement. All right. So when you see this candle, buyers are in control. I'm just repeating that so that we may be clear. So these are the different parts of the bullish candle. And whenever you see these wicks here, it means let me explain what is happening here, because whenever you see a print out on your chart like this one candle, this is a daily candle. We are concentrating on a daily candle for now. Okay, this is a daily candle. So from the beginning of the day, it opened here. This candle opened right about there. It opened here, okay, and it closed here, up here. It opened here and closed here, okay. This is its close. It opened here, closed there. But we have these protrusions here, the upper wick and the lower wick. What do those lower wick and upper wick mean? I'll explain, all right. So why you see this at the beginning of the day, the price opened here, okay. It opened here, but then when it after opening, okay, it opened here, but after opening, the sellers pushed the market a little bit lower. There was some selling pressure that pushed the market a little lower before it returned and went all the way up, okay, up to this point, okay. So when it got to this day high, okay, sellers again pushed the market a little lower, the price a little lower to close at this point. This is what it is communicating to us. All right. I hope you got that clearly. Okay. Let me repeat that. The price opened here. Okay. It opened here at the beginning of the day, but there was some selling pressure that pushed this price a little lower to this point. Okay. To the daily low, before buying pressure stepped back in to push the price all the way up here to the daily high, before again some selling pressure came into the market to push the price a little lower to this point before it closed for the day. That's what this candle is communicating to us. So pay attention to that. So between here, from here to here, there is some selling pressure. All right. I will say there is some selling pressure here. Okay. Selling pressure. Okay. That would be some selling pressure there. Okay. This would be some selling pressure here, which pushed the market a little lower before buying pressure stepped in to push that price higher. So there is buying pressure that pushed the market all the way up here. Okay. Back to this daily high. So pay attention to that. That's what this candle is communicating. That's what this wick means. Okay. And also at the top here, what it means is that when the price go to the day high, there was some selling pressure which pushed the price from the day high to the close up here, down here. Okay, so this is selling pressure also. Still, that would be selling pressure. Okay, so more selling pressure here. Okay, but on the other hand, buying pressure pushed even after this selling pressure. Okay, even after this selling pressure, okay, buyers came back into the market at this daily low and pushed the price all the way up to this day high before again sellers push the market a little lower or the price a little lower to close at the end of the day. So that is what this candle is communicating to us. All right, so pay attention to that. So moving on to the bearish candle, it's just the opposite of the bullish, okay, of the bullish candle. So this would be the bearish candle, okay. It looks like that. So the bearish candle normally is color coded by most traders red, mostly red. Yeah, it's mostly color coded red. So what it communicates is the opposite of what the bullish candle communicates. So this would be the bearish candle, okay. This would be the bearish candle, okay. That would be the bearish candle, okay. This is the bearish candle. I'll just color code that red, okay, just to be consistent. Okay, so this is the bearish candle. This would be its body, okay. This is the body of the candle, okay. This is the body, okay. I'll color code that black so that you can see. This is the body of the candle, okay. That is from this point, to this point is the body of the candle. That is the body, okay. And up here we have the daily high also. This would be the daily high, okay, day high, okay. This is the day highest price of the day, okay. This is the open, hold on, this is the open up here. It's just the opposite of the bullish. This is the opening price because the price is heading lower, okay. It's dropping. So this would be the open, and then this would be the daily low still, okay. This would be the daily low price here, and then this would be the close, okay. This would be the close right here, the closing price of the day at the end of the day. This is also a daily candle. That means it takes a full day to form from up here, from the daily high to the daily low. It takes one full day to form, okay. It takes one full day, 1 day candle, okay. It takes a full day to form, all right, from the high price to the low price of the day. So the communication here is just the opposite of the bullish candle. So it means, this means that the sellers were more in control within this range of the candle from the day open to the day close. Sellers were mostly in control. There was more selling pressure than buying pressure, okay. So what we see here is that the market opened here at the beginning of the day at this price. It opened at this price here, okay. But there was some buying pressure, okay. A little buying pressure from this opening price to this day high, okay. There was some buying pressure, okay. Some buying pressure here. There was some buying pressure. Buying pressure, okay. There was some buying pressure that pushed the price a little higher here. This is some buying pressure, push the price to the day high before sellers took over again and pushed the price all the way down to this day low, okay. Push the price all the way to this day low, okay, before again sellers came back and pushed the price a little higher to this point and closing at the end of the day, okay. After some buying pressure, push the price a little higher. So we have buying pressure up and buying pressure down, pushing the price a little, okay. But generally we are looking at more selling pressure to the downside. So we have more selling pressure to the downside. So we have here more selling pressure, all right. We have selling pressure to the downside, all right. Selling pressure. During that day we have full selling pressure, mostly selling pressure during the day. So it means the sellers were more in control during the whole day. They pushed the price from this open to this close, okay, lower than it started, all right, at the beginning of the day, okay, lower than it started. And on the bullish, it closed higher than it started. So also with the bearish candle, we have the lower wick, which is this one here. All right, we have this lower wick, okay, and we already know what the lower wick communicates, okay, lower wick or lower shadow. And then we also have the upper wick up here, okay, upper wick. All right, so that's what this market communicates. Again, I'll repeat what this is saying. So at the beginning of the day, the price opened from here, but then there was some buying pressure which pushed the price a little higher to this daily high, before again sellers came into the market and pushed the price all the way to the daily low here, okay, to the daily low here, before some buying pressure came into the market and pushed the price a little higher to close at the end of the day here. Okay, so that's what it communicates here. This is the communication you see. All right, I hope that is clear. Before we move on, this must be understood so that we know what we are going to be doing in the next step of this lesson. So let's go over to the next part of this lesson, and I'll be showing you a bullish continuation strategy. Okay, so we are going to start with a bullish continuation, and then we are going to the bearish continuation. So in this next segment of our lesson, we are going to be looking at a bullish continuation bias, okay? A bullish continuation bias. That's very important, okay? So pay attention to this. Pay attention, all right? So we are looking to buy in a bullish continuation bias. We are looking to buy, all right? We are looking for opportunities to buy or to go long, okay? We are looking for opportunities to go long in this strategy, okay? In the bullish continuation bias, we are looking to buy. All right, so that is clear. Let's move on. So in a daily candle, if you see a daily candle like this one, so we are looking at this daily candle. There's this daily candle here. It takes one day to form. So when you see this candle, this is our first day. As you can see, day number one, okay? What we are looking for, what we do on the chart is to mark out our lowest price of the day. Okay, guys, please ignore the noise at the background. I'm sorry for that. I hope you can hear me clearly. So we mark out our low price of the day, which is this one. This is the low price of the day, and this is the high. You mark out from that lowest tip of that candle to the highest point of that candle. That means the lowest price and the highest price of the day, okay, after the candle closed, okay, after the candle closed. After marking out those areas, okay, the high and the low, as I've already marked out here, you can see this is the low and this is the high, okay. Drag it to your right, okay, you mark out like that on your chart, and then wait for the second day's candle, okay. If that candle closes above the high of the previous day, which is this one, okay, previous day, this is the previous day candle, okay. If the price closes above, like the way you see here, this one closed here, all right, it closed above these highs of the previous day candle. If it closes up, and the close has to be the body's close, don't consider the wick, okay. It has to close with its body above the previous day's highest price. This is the highest price of the previous day candle. So this candle the next day should close above with its body above the previous day's highs for it to be valid. All right, for this bullish continuation bias strategy to work, this candle, the next day's candle, the second candle, has to close above with its body. It has to close above the previous day's high, which is this one. All right, hope that is clear. After it's closed, we are then looking for a confirmation for our entry to go bullish or to go long, to buy after this second candle has closed. So what we are looking to do is to buy. So this candle also takes a full day to close. After it's closed above this one, then we are looking to buy the next day. Okay, so what we do is to go to our lower time frames after this second day candle has closed above this first one. Okay, what we do is go to our lower time frame entry points, all right, like the 5 minutes, all right, 5-minute chart or the 15 minutes chart for our entries to go long, that is to buy. So why we got the lower time frame is so that we can sharpen our entry, so that we can enter, we find chart patterns at lower time frames like 5 minutes or 15 minutes. I prefer the 15 minutes, but 5 minutes is also okay for our entries in this strategy. So first, in the daily time frame, you are looking for the first candle to close, and then the second candle closes above the high of the previous day's candle. When that happens, you go down to the lower time frames, 15 minutes or 5 minutes time frames for your entry. Okay, and then you look for chart candlestick patterns at the lower time frames for your entry. Like in this case, you would use this is 3 white crows. Okay, I mean 3 white soldiers, sorry. This is just to illustrate. Okay, this would be 3 white soldiers here. Okay, this would be 3 white soldiers. You see this? 3 white soldiers. After the close of the third white soldier, you would place your buy. This point is at the lower time frame of 5 minutes or 15 minutes. Okay, I'm just illustrating with this candlestick pattern, 3 white soldiers. Okay, so after going to the 5 minutes time frame, after the close of this second candle, you go to your 5 minutes time frame and place your buy there. Okay, your entry will be around there in the third candle. Just as the third candle is beginning, you go to your lower time frame, 5 minutes or 15 minutes, and look for your candlestick patterns, okay, to confirm your entry for a long position. Okay, and target a 1 to 2 risk to reward ratio. Okay, this is a 1 to 2 risk to reward ratio. Sorry, you target a 1 to 2 risk to reward ratio. This would be 1, this would be 2. Okay, target a 1 to 2, your take profit up there, and your stop loss just below this first white soldier. Okay, that is in case you get 3 white soldiers, but there are several other candlestick patterns which can confirm your entry, like a bullish engulfing. You see this bullish engulfing candle, this one here. So in this, in one case, it can be a bullish engulfing candle, which is normally our confirmation entry candlestick pattern to go long in lower time frames. If you see a bullish engulfing at this point, okay, after the close of the second candle here, after the close of the second day candle, okay, and you are looking for longs, you wait for your bullish engulfing candle to close before you can place your long position and target a 1 to 2, okay, risk to reward ratio to the upside. Place your stop loss just below the bullish engulfing candle or your support area, whatever. This is more effective if you use it with other confluences like support and resistance, trend lines, and all that kind of stuff. This is not like a standalone strategy. It's better. You can trade it alone, but it's more effective if you use other confluences like trend lines, support, and resistance. So this is how it would be in the bullish continuation bias. I hope you understand. I'll just go through quickly, all right, for you again. So this is the first day's candle. At the close of the first day's candle, okay, here, when the candle closes, the next day's candle also has to close above the previous day's candle with its body, not with the wick. You consider the body. When the body closes, you go to your lower time frames, 5 minutes or 15 minutes. At the beginning of the third candle, this will be the third candle for the third day. At the beginning of that third candle, you go to your lower time frames, 5 minutes or 15 minutes, to look for your entry. You look for candlestick patterns like 3 white soldiers or bullish engulfing candle at lower time frames to confirm your entry to go long. Okay, and place your stop loss in appropriate areas like below the first white soldier here, or at the below the bullish engulfing candle, and target a 1 to 2 risk to reward ratio to the upside. All right, I hope that is clear. We are moving on to the next one. Hello guys, so to continue, we are looking at a bullish continuation. Just to illustrate here on the real chart, as you can see here on the real chart, this is how it would look like. I just want to mark out some areas for you to see. As you can see here, okay, this is a bullish daily candle here, the big one. Okay, this is the first candle day, the daily candle on the first day. This would be the daily candle on the second day, the next candle. As you can see, this would be the second candle on the second day. When that candle closes, if you look closely at the second candle, okay, look closely at this candle, the second one, all right, you can see that it closes, okay, it closes above the highest price of the previous day candle. Okay, this is the daily high. As I've marked it out here, this is the daily high, this is the daily low of the first day candle. Second day candle closes above the high of the first day candle. Okay, confirming our bullish continuation bias. All right, that confirms our bullish continuation bias. So we are looking to buy in the next bullish candle, which is this third candle here. At the beginning of this third candle, this bullish candle here, we are looking for our entries below here. So our entries are below this point here. Okay, our entries are somewhere here. Okay, at the beginning of that third candle. Okay, so that's where we will look for our bullish engulfing candle. Okay, we will be looking for our bullish engulfing candle around that area. So we would be looking for something like this around that point, a bullish engulfing candle pattern around this area, around here. Our entry would be here at the third candle, all right, at the beginning of the third candle, and then we'll target a 1 to 2 risk to reward ratio going upward, and you would win this trade for sure. All right, so that would be our daily bias confirmed here. It's a bullish bias. The second day candle closed above the first day candle, confirming our bias to the upside. So we are looking to buy at the third candle here. All right, so that is how it would look in a real market. Let me mark this out: first candle, second candle, and then our entry would be at the beginning of the third candle here. Our entry would be there. All right, so this is the open, this is the close, this is the daily high, and then the second day it closed above the previous day candle, and then we are going to our 5 minutes or 15 minutes chart to confirm our entries at the beginning of the third candle, this one here. All right, and then we target a 1 to 2 risk to reward ratio to the upside, and we would win that trade. In the same trend, we are looking at the second example here, second illustration. This is the first day candle, bullish candle, and then the second day candle closes above the previous day candle. Okay, this second candle here. Okay, this is the first candle, this is the second day. It closes above the first day candle. Okay, confirming to us a bullish continuation bias, all right, with that second day candle. So we are looking to continue the bias to the upside. So at the beginning of the third candle here, okay, at the beginning of that third candle, we are placing our buys. First, we got the 5 minutes or 15 minutes chart, okay, to confirm our entry using a bullish engulfing candlestick pattern or 3 white soldiers, whatever candlestick patterns confirms your entry at lower time frames. You use that at the beginning of the third candle up here, all right, and then you place your buy going all the way up 1 to 2 risk to reward ratio at these lower time frames of 5 minutes and 15 minutes. Okay, don't do it in the daily chart. Okay, don't place your 1 to 2 risk to reward ratio on the daily chart. Go down after confirming that it is a bullish bias with the third candle beginning. Go to the 5 minutes or 15 minutes time entry and time frame entry and confirm your buys. Place your trade there and place a 1 to 2 risk to reward ratio going to the upside. So we are looking at a bearish continuation bias. It's just the opposite of the bullish continuation bias. Okay, so here we are looking at the highest price of the day here. Okay, this was our highest price. And then the sellers drove that price all the way down to this low price, okay, of the day. This is the lowest price of the day here, okay, before this candle closed here. Okay, this was the close of this candle at the lower than it opened at the beginning of the day. Okay, so we are looking to sell in this formation. All right, so what we are looking at here is, first of all, this candle here. We are looking at the formation of this first candle here, the full day. This candle formed the full day. It opened here, okay, and closed here, but it formed a low price here. So we are looking to sell, okay, in this bearish continuation bias. So look at the second day. Look at what happened the second day with the second day candle. All right, second day candle closed below the lowest price of the previous day. You can see, all right, the second candle closed below this previous low of the first day. Okay, so in the second day we have this candle closing below, confirming our bearish continuation bias. So we are looking to sell beginning with the third candle, bearish candle. So this would be our entry right here. Our entry would be at the beginning of the third candle. All right, at the beginning of the third daily candle. Mark that, has to be a daily candle. So when we see that daily third candle beginning bearish, okay, we are going to place our sell position at the beginning of that candle. But we do not place it on a daily chart. We do not place our sells on a daily candle, okay? We go to our 5 minutes, okay? Go to your 5 minutes, okay? Or 15 minutes time frame, okay, and enter at 5 minutes or 15 minutes time frame. Look for your candlestick patterns to the downside. All right, candlestick patterns like 3 black crows, like you see here. This would be 3 black crows. Okay, place your sell at the end or at the close of the third black crow and target a 1-to-2 risk to reward ratio going downwards. This would be a sell. Okay, enter your trades at 5 minutes or 15 minutes time frame, okay, after confirming the third candle here has started and the second one, the second candle has closed, all right, below the first day low, okay, low price. So that is what it will be, and the close of the second day candle should be with its body, not with the wick. Okay, it has to be a close with its body, not with the wick. You mark that right. Okay, so this is what you would do in a bearish continuation bias. It is similar to the bullish except in the reverse. So in you can use candlestick patterns which you prefer, but I would prefer, mostly people use the 3 black crows, and the bearish engulfing candle is more common. Okay, a bearish engulfing candle. If you can find a bearish engulfing candle like this one, is a bearish engulfing candle. All right. When you find this one in a lower time frame, use that as your entry, okay, and place your 1-to-2 risk to reward ratio all the way down, okay, as you sell. So that is a bearish continuation bias. I'm going to show you this on a real chart. So guys, to wrap it all up, we are going to end with this bearish continuation bias, okay? And we are looking at the real chart here, just for our to demonstrate here on the real chart what happened in history, okay? So we are looking at the daily chart here, and we see this daily bearish candle, okay? This daily bearish candle on the first day, okay? The first day candle, and then the second day candle here, okay? Closes below the previous day low. All right, this is a daily low here, this is a daily high, this is a daily high. Price started from here, closed there. Okay, I just don't want to make this, I want to make this as clear as possible. So we can see our daily candle here. Okay, this is the first day, and then the second day candle closed below the previous day candle. Okay, and then we see it closed below the previous day candle. So this is, it closed below this price of the previous day candle. So we target our sales beginning with the start or at the beginning of the third day candle, this third day candle. Okay, so I'm just going to mark out the third day candle. This would be our third day candle, this one here, okay, that candle there. So at the beginning of this candle below here, at the close of the second candle, let me just mark out first day, second day, then this is the third candle, okay. So at the beginning of the third day candle, we would place our sales, okay. We would go to a 5 minutes, okay, 5-minute chart or 15 minutes chart, okay, and look for our confirmations to the downside, like 3 black crows or bearish engulfing candle at the close, okay, of the second day candle or at the beginning of the third day candle. Okay, we'll place ourselves and target a 1 to 2 risk to reward ratio. And as you can see here, what played out in history, what played out here, okay, what played out here, you can see that after the second day candle closed, the third day candle went all the way down. This is a daily candle. It took 1 day to open and close down here. Okay. So if you are placing your trades in the 5 minutes and 15 minutes time frame, you'd hit profit at 1 to 2 risk to reward ratio, even 1 to 3 risk to reward ratio if you placed it at a lower time frame, which is why you should not enter on a daily time frame. You enter at 5 minutes, okay, after confirming your candles on a daily time frame. You go to the 5 minutes and or 15 minutes or even 30 minutes and place your trades to the downside. So this trade would actually win. Okay, it means you are betting on this daily bearish candle to close below the previous day candle at the end of the day so that you can make profit. I hope that is well understood. The second illustration is this one here. You can see the first day candle here. Okay, this is the first day candle, and then this is the second day candle here. It closed below the lowest price of the previous day candle. All right, and then at its close, we can see the third candle. We can see the third candle over here. Okay, we can see the third candle here. All right. So at the beginning of that third candle, we place our sales. Again, we go to the lower time frames of 5 or 15 minutes and place our entries there after confirming a bearish candle or some candlestick pattern like 3 black crows to the downside. So what we are betting on, we are betting on this third day candle to close lower than the previous day candle. We are betting on this third day candle to close at a lower price than this previous day candle. That's what we are betting on. So we are placing our sales here and we are hoping that price will drop all the way down here so that we can make that 1 to 2 risk to reward ratio or even 1 to 3 risk to reward ratio and take our profit by the end of the day. So that's what we are hoping to do. All right. So thank you very much. If you have watched this video till the end, consider liking and subscribing to this channel. Like this video and subscribe to the channel.